Okay, good morning, everybody. Thank you for joining us for Cashflow Forecasting 101. Hopefully you can all hear me okay, and that the video is working all fine. Maybe just let me know on chat if there's any problems, but it looks like it's all working. Excellent, thank you. Firstly, a very big thanks to the team at Screen New South Wales for putting this program together and for providing such great support for the screen industry overall in New South Wales. I would like to begin today by acknowledging the traditional owners of the land on which we're meeting today and pay my respects to elders past, present and emerging. And before we start, I'll have Danny from Screen New South Wales join us just quickly for bit of an update on what they're doing. Here she is.
Hi everyone. Hi Ian, thank you. Yes, I would also like to acknowledge and pay my respects to the traditional custodians of the land on which we are gathered today. For me, it's the Gadigal people of the Eora Nation, and pay my respects to their elders past, present and emerging, and also acknowledge all Aboriginal and Torres Strait Islanders who have joined us today. My name is Danielle Baines and I'm one of the managers of the Screen Industry and Audience Development team at Screen New South Wales. I'm so glad that you're all joining us today for what I know is going to be an incredibly informative webinar. And I want to thank Ian Murray and Samantha and Richard from 113 Partners Consulting for putting this together for us. This is actually the second in our series of webinars, the Screen Connect series, and we are busily putting together more panels and webinars and digital events with other fantastic speakers and guests, which we will be announcing over the next coming weeks. So to stay informed about those events, you can sign up to our e-news via the Screen New South Wales website. You can also follow our social media channels, and you can actually also follow our Crowdcast channel so that once new events are open for registration, you will be notified automatically. Another initiative that we are running at the moment are our weekly one-on-one meetings with the Screen sector investment managers. So this is an opportunity for screen content producers and screenwriters and filmmakers, and they can book in a video conference meeting with the investment managers to get first-hand advice about projects and development and discuss pathways to finance and markets, and just a great way to build relationships with the agency. So these are taking place every Thursday on a rotating basis, and there is an email address to book in, and we will link that in the chat box for you. But get in touch if you have any other questions. But yeah, that's it from me. I won't take up any more of your time. I'll let you get underway. But thank you again, Ian, Sam and Richard, and to AI Media who are providing live captioning for us today. Enjoy everyone. Have a great morning.
Thanks so much, Danny.
Thanks.
In the interim, I'll just start with some housekeeping elements. So firstly, I just wanted to clarify that this presentation is about building cash flow forecasts for businesses overall. It isn't about specific project-based cash flow forecasting. So we're not looking at cash flow forecasting for a particular film or television show or screen projects you might have. This is for a business overall. Sam, who is down the corner at the moment, is one of the partners in 113 Partners, and she'll be driving the PowerPoint slides today and be joining us again at the end of our Q&A sessions. Another one of our partners, Richard Harris, moderating in the chat window, and we'll be posting links as we go. I won't necessarily be able to pay a huge amount of attention to that part of the screen because I will be screen sharing a fair bit as we go through this presentation. So Rich will be keeping an eye on that and moderating any questions you might have and adding them into the question bar at the bottom. If you can actually ask your questions directly, I'll come to that in a second. And Richard will be joining us again at the end of the session to talk about finding new income streams, and also be joining us for the Q&A session at the end there. Also, we'll try to take breaks at logical points throughout this presentation so you can have a bit of a stretch, use toilet, top up your tea, give your brain a bit of a rest as we go as well. And lastly, just want to remind everybody the information we're sharing today is generic, and that sorry, seeing back in here. It's generic in nature, and that we recommend if you do have any specific questions about your business and your specific financial situations, that you do talk to your accountants and financial advisors and get their professional advice as you need specifically for your circumstances. But these tools will be generally useful for most people in the screen industries. Before we get started on the presentation, I probably should just introduce myself and the other partners in the business and the business itself. So starting with 113 Partners themselves. Now, 113 Partners is a strategic advisory business. We work almost exclusively with creative industries. So about half of our clients are from film and television businesses, and the other half are made up of games companies, advertising businesses, media design agencies, interior designers, corporate video producers, music labels, distributors, all sorts of other types of businesses. What we really focus on is helping our clients to achieve bottom line growth. So sometimes that means getting bigger, or sometimes it means getting smaller, but generally it's all around making sure that the business is more profitable at the end of the day. Sometimes it's about getting investment or additional resources, and oftentimes we're working with businesses to help them to determine an exit plan. So an exit may be around actually getting a business in shape for a sale or investment, or sometimes it's around succession planning. But at the end of the day, the whole premise of our business is, and it's in the name, is the idea that 1 + 1 = 3, which isn't particularly good maths, but it should be good in business anyway. Briefly introducing the various partners in the business. Of course, there is myself, Ian Murray, and I started the business about 8 years ago. My career has been generally in CFO and COO roles in advertising, media and television production companies. Immediately before we started 113 Partners, I was the COO at Freehand TV. Back at that time, it was partially owned by BBC worldwide. And after we helped Peter and John buy their business back from the BBC, Mark Ireland and I set up Untangled Octopus, which we ran together for about 5 years before we split the business into two. So Untangled Octopus, which some of you probably work with, is now focused just on production accounting and offsets. And 113 Partners, which was my half of the business, is focused really on business growth and strategy and investment. Okay, sorry about that. The other partners in the team, as I was saying, is we have Sam Guth-Lieben, and Sam has over 20 years experience working across media, cultural and arts organisations. Let's make that a bit bigger so you can see all this. Mostly at the ABC, and she's a finance, business and operations specialist. We also have Richard Harris, who many of you will know. Richard's worked in leadership roles across the screen industry, working as the head of business and audience at Screen Australia. We had the responsibility for distribution, international strategy and the enterprise program. And prior to that, he was the CEO at the South Australia Film Corporation, and he's also been, amongst other things, the executive director of the Australian Directors Guild. We have Jennifer Wilson, who's our resident technologist and our digital guru. Jen's been working at the intersection of entertainment and technology for more than 25 years and has successfully run, sold and invested in a number of fascinating technology businesses over that time. John Gregory, who I had the pleasure of working for at Freehand TV, also works with us across a range of projects. John's coalface experience in running television businesses has spanned a number of continents and companies. He started in the industry with Grundy Productions when he was in Monaco in the early 90s. And he spent time as a general manager at Beyond International and a number of other ventures before starting the Freehand Group about 16 years ago. And last but not least, we have the fabulous Fiona King, who is our marketer extraordinaire. And Fiona has held leadership roles at the Nine Entertainment Company, 20th Century Home, Fox Entertainment, Foxtel and ACP. And of course, you may know her because she was the inaugural head of marketing at Stan before, during and after its launch in 2015. So we might move on to a quick agenda of what we're going to cover today. The first thing is why forecast? So what is the purpose of forecasting? What benefit does it give us? Why would we go through the process of doing so? Then we're going to look at the different forecasting models and tools. So what are the different tools which we have available to allow us to do forecasting? We're also going to go through the process of building out a simple cash flow forecast using a dummy company so you can see how it's done. So that'll be a worked example, which will probably take the majority of our presentation time together. We're then going to have a look at scenario modeling, so how we can use that model that we've built for our dummy company, and we'll work this through in the live example as well to sort of show you various scenarios and the impact of how they can work with the business moving forward. In this case, we're specifically going to look at what modelling a 30% reduction in turnover means for a business, and then we'll also have a look at what the impact of a number of the government stimulus packages which are coming online now and how they might assist a business if it is experiencing that sort of downturn in turnover. We'll also have a look at cost reductions. So we'll spend a bit of time thinking about what cost reductions during these difficult times may be and the sorts of things we should consider and how we go about implementing them. We'll move on to income streams, and that's where we'll have Richard join us as well. It's absolutely true that you can't cut your way to success or to cash flow positivity, but now more than ever it is important to think about how you can evolve your business offering, find some new income streams to help support your business. And then we'll close with a Q&A session so we can, again, address any of the questions you might have as we go. And again, just reiterating, at the bottom of the screen there is an Ask a Question button, so please use that if you've got any questions as we move forward. So firstly, what is cash flow? Cash flow simply is the money that moves, that's moving, and for some reason we use the word flowing, in and out of your business each and every day. So cash comes in from your clients, from your customers, sometimes from you as well, from your investors, from financiers, from the government, and from the collection of receivables. So that's money that's owed to you by your debtors, so invoices you've sent out that you're waiting to collect. And cash goes out from your business for payments such as payroll, for tax, for rent, cost of delivery of projects, payment of debts you might have to suppliers, and so on. So it sounds fairly simple, but cash flow is one of probably actually the biggest sources of stress for most business owners. Specifically, people get stressed about not knowing in advance what their cash flow is going to be like. And so to help reduce that stress, we forecast. So why do we forecast? Well, we do it for a few reasons. Firstly, it helps to reduce the stress that comes from uncertainty, but it also helps us allow to do some other things like testing scenarios. Just make the screen so you can see me a little bit more as well. So yeah, it allows you to also test scenarios. What happens if you put on new staff members? What happens if you expand your office? What happens if you win that new account, or if that project gets greenlit? Or what happens if you take out that car lease? It allows you to have a look at those different scenarios and figure out what the impact on your business is going to be. Cash flow forecasts give you some of the answers to those sorts of questions. We also use cash flow forecasting to demonstrate viability. So if you've ever taken out a loan, especially in these sort of uncertain times, the bank you're talking to will almost definitely want to see your financial forecasts, including your cash flow forecasts. And even if you don't give them cash flow forecasts, they're going to use the information that you provide them when you're applying for that loan to actually model one for themselves to understand what your cash flow looks like. And investors want to see the same sort of data. When we're preparing investment decks or information memorandums for investors to review when we're helping businesses seek investment, we always need to include cash flow forecasts in those IMs and in those documentations. So no matter whether the business is an established one that's been up and running for years, or whether it's a startup seeking capital, we need to provide that sort of information about what the cash flow forecasts for those businesses are. So ultimately, cash flow forecasting is about getting better information to be able to make better decisions. I can't tell you the number of times we've had clients who've been sideswiped by a tax bill they didn't know was coming, or a superannuation deadline they just had to scramble to find the cash for. Or they've got to the end of the year and they've paid themselves a big bonus because the P&L will show they had a good profit, but then suddenly discovered they had nothing in the bank because they'd spent all of the cash which was there. So having better knowledge allows you to be able to make better choices about when it comes to spending your money, and helps you to avoid nasty surprises. In terms of why cash is important, one of the analogies you'll often hear being used when we're talking about cash is to consider it as some sort of fuel. So if you think of your business as a car, then cash is the fuel that it needs to run. And that analogy translates into some of the terminology that you'll hear people using when they're talking about cash flow. Right now, we're in pretty unprecedented times. The coronavirus is having a massive impact across the globe and across a range of industries, but screen industries in particular are facing some challenges that we could never have anticipated. So while many of you have been running your business for years, and decades in some cases, right now we've got a lot that we can learn actually from the startup sector. And two of the two main key metrics which startups, and tech startups in particular, use and keep a very, very close eye on are these two terms called a burn rate and their fume date. So a burn rate is simply the rate at which they're burning through their cash. So after I take whatever cash is flowing into the business away from the cash that's flowing out of the business, how much cash am I spending or burning every month or every week, or in some cases every day? So your burn rate allows you to figure out what they call your fume date. And your fume date is the date that the business expects to run out of money. Going back to our fuel analogy, it's the date that we've used up all the fuel in our tank and all we have left are fumes. So fume date and burn date, or burn rate, are two of the terms which you'll often hear used there. Startups don't spend a huge amount of time looking at their P&Ls and historic finance data. They spend most of their time looking forward and calculating how long they have before they need to raise some more capital or become self-sufficient. And that's really the attitude that most of our clients really need to be taking right now, and across the whole of the screen industry. How long can we maintain our cash balances to ensure that we can continue to have viable businesses until we come out the other end of this? One thing that we don't have is certainty about when this is all going to end. We don't know when business as usual is going to resume, or indeed whether or not business as usual ever will resume. But what we can do is get a better understanding of what our future cash flows are likely to look like, so we can make some decisions now to help protect ourselves down the track. One of the other concepts which is worth thinking about during this period is what's called a cash floor. So what's the minimum amount of cash that you want to maintain in your business? And this is particularly useful for businesses and business owners who've spent many years building up businesses and so might have healthy bank balances right now. It's important to remember that during periods where you haven't got any income coming in, that those bank balances can evaporate very, very quickly. So it's worth contemplating what's the minimum cash balance you actually want to preserve in your business. There's a number of different models which we can potentially use when we're going through cash flow forecasting. We're going to be going through a very simple cash flow forecasting model today. It's something that you can build really just by reviewing some of your bank statements and making some predictions about the future. And it's also the model, the one which we're going to be reviewing today, is the model that we tend to use the most week to week with our clients, because it allows us to forecast on a weekly basis. You can even get down to a daily basis if you want to in extreme circumstances, but we tend to do it on a week-to-week basis. When we're doing longer-term forecasting, for instance, a 3 to 5 year projection for a business, we tend to use what's called a three-way model. Now that's a much more complex forecasting tool that's actually driven from forecast variations in a business's balance sheet. And it's a model which banks and investors like to see us use because it's very logic driven, and it ties together both a profit and loss, a balance sheet and a cash flow into a single model, which is why it's called the three-way. It's got those three elements to it: the P&L, the balance sheet and the cash flow. And three-way cash flow forecasting is particularly useful when you're testing out a model over a long period of time, or try to establish the maximum cash burn of a business over multiple years. You'd really need to understand how balance sheets work in order to be able to build a three-way properly. However, and one of the other disadvantages is, because it is P&L and balance sheet driven, is that and they tend to be prepared on a month-to-month basis, then three-way cash flow forecasts tend to only be able to be modelled on a monthly basis as well. You can't get down to that sort of weekly granularity which we can get with the model which we're going to be using today. But for those of you who are interested in how to build a three-way cash flow model, please just contact me directly after this webinar and we can have a chat about how to create one of those. For those of you who are using cloud-based accounting tools, so things like Xero or MyOb in the cloud, you may be familiar with a number of cash flow forecasting tools that have come onto the market over the past few years. We've tested quite a few of them. Have generally found that while they're nice interfaces and quite pretty to use, the effort that you would spend in actually getting them set up with sufficient data for them to be useful, in that amount of time you may as well just build your own in Excel or Google Sheets. But if you are interested in playing around with such tools, there are a number of app marketplaces that you can have a look at. So if you go into those app marketplaces and just search for cash flow in the marketplaces of your preferred cloud software provider, so in either the Xero apps marketplace or the MyOb apps marketplace, then that's a good place to start and just have a look and make sure that you're familiar with them. What we might do, we're going to jump into Excel now, and I know we're about half an hour into this, which is fairly early in the piece, but what I might do is just take a quick pause, and we might just have give everybody a break just to have a coffee. We'll see if we can get this this PowerPoint working more effectively, so I'm not running both screens at once. We can get Sam back online doing that. So if you have just a moment to take a break, we'll regroup in about maybe 5 minutes. So go grab a coffee and those sorts of things, and we'll regroup in 5 minutes. Thank you. So we got everybody back? Excellent. My apologies about that. So yeah, what we're going to be doing is jumping in to have a look at some live examples in an Excel model. Let's go to the right section here. The information which we're going to need to be able to do that is, as I said earlier, ideally you're going to need to have at least some bank statements, but ideally you also have access to some accounting software which you're using, so we can get access to a few other pieces of information. The main piece of software you're going to need is some sort of spreadsheet software. So Microsoft Excel is great for this, but also Google Sheets, Apple Numbers, OpenOffice, they're all options you could use instead of Microsoft Excel if you don't have that. From your accounting software, the data we're going to be able to, or we're going to want to be able to access, is your accounts receivables and your accounts payables data. And if you have staff, then we're going to be using some of the payroll data from within those, within your accounts package as well. But if you don't have access to payroll data for some reason, there are some good tools like the paycalculator.com.au site that you might want to be able to use to make your assumptions a little bit more accurate. So let's start by talking about the steps involved in building this model. There are about 5 basic steps which we need to follow when we're building the base model. I'll see if I can bring up for you what that looks like. No, I can't. Firstly, we're going to build a baseline model, and then we're going to add in some historic data from bank statements. Then we're going to add in existing creditor and debtor data from our accounts receivables and accounts payable statements. Then we're going to be adding in payroll and other recurring transactions that we can quantify in advance. And then lastly, we're adding in taxes and other liabilities that might vary from period to period. So this should give us a fairly clear picture of the world as we know it, but let's get started. So in the drop box at the bottom, we've provided a number of different versions of this Excel as we move forward. So you can sort of start at number 1 and work your way through at the various stages of building this template out. The basic template which we've got in there, which is the one which is simply called number 1 cash flow template, blank, you can use and you can modify to suit the needs of your own business. So the first thing that we do is we start by entering in the key types of income that we're aware of, which makes sense for your business. So in some instances, these are going to be very project-based. In other instances, you might put in the names of clients where we've got the names of different projects down the side here. It's going to vary from business to business. In our dummy company that we're working with, this is a project-based company. Some of the other information which is going to be relevant later on is that it employs about 10 full-time staff members. It engages some additional employees from time to time to work on specific projects on a casual basis. And we have it registered for payroll tax in New South Wales and it lodges quarterly basis. So because this is a project basis, we've just started by creating 10 basic project categories down the side here at the top. And then we have some of the other income categories which are going to likely to be recurring, things like interest coming in. And we've also made allowances in here for being able to have JobKeeper receipts when that happens. In our model, we've also got some costs which are in there, our overheads, things which are going to be our cash outflows. And we've broken this into 5 different sections. We have the variable costs, which are likely to run as a result of actually delivering particular projects. We've got our expenses and our general overheads, which we bundled together. Some of the areas we bundled into account headers, like general expenses, for instance. Whereas other areas where we can sort of have that granularity of being able to see recurring costs going out on a regular basis, we've actually called those out as specific things. We've also got in there an allowance, for instance, for making credit card payments. So in this example, we have a business that pays for a number of expense items on a credit card, which is regularly topped up. And so because of the way in which that works, for our model, we've simply allowed for those transfers over into the credit card rather than breaking that down into the granularity of exactly whether it was for coffee meetings or parking or entertainment or things like that. We then have our salaries and wages. In this instance, as I said, we've got both our core staff, our 10 core staff, and then we have project staff who work just on specific projects as they're brought in. And then we've got accrued liabilities, which are things like our tax, our superannuation, some of those other items that were in the balance sheet. And you'll see that we've separated these types of activities out into different clusters of a similar type. For instance, we put all our cost of sales together and all of our general overheads together, just to make it easier later on when we need to start running some formulas for doing some calculations. At the very bottom of the screen, we have our cash inflows and our cash outflows separated, and then we've summed those together. So sorry, not at the bottom of the screen, at the bottom of each of these sections, so at the bottom of both our income and our cash outflows, there's a summary of what those totals are. And then at the very bottom, we have a formula which calculates a number of things. So firstly, we look at just the difference between our total cash inflows and our total cash outflows, which gives us our net cash movement for the week. And then at the bottom, we just keep track of our opening and closing bank balances for each of these periods. So on a week-to-week basis, what we're looking at is what our opening balance for cash is at the beginning of that week and what our closing balance for cash at the end of that week is. In this model, we've broken our periods down into weekly transactions, so we can actually track this data on a week-to-week basis. The dates at the top of the page are the first date in the weekly period. So when we look at the date at the top, the 30th of December 2019, for instance, in column B, what that means is that's the first date of the 7-day period that we're measuring for this particular one. And we've run this model all the way through to the end of the calendar year. The other thing that we've done just to keep life simple is we've frozen the first column and the first row. So as we move around in this model, we can still see what our headings are and the dates that we're working on as we're moving around. So you can modify this model to suit your own requirements. Sometimes it's useful to run a profit and loss statement out of your finance system, so you can sort of track see what sort of incomes that you track and what sort of cost categories you use. I think the important thing just to bear in mind here is not to overcomplicate this model. So just use those key headers which are going to actually make sense for your business without necessarily getting down into nitty-gritty detail where you're going to be tracking too much data in this sort of model. You can add extra rows into this template and it shouldn't break anything. So if you do need to add in additional rows, you can insert additional rows there and the formulas probably will still hold together, but it's worth just checking as you do those sorts of things to make sure that the data period that you're actually that you're using from your formulas is still maintaining its internal logic. So the first thing we're going to do after we've built this model is we're going to add in some historic data. And now you'll see in the Dropbox that there is a file there called Sample Bank Statement XLSX, which is just an example of some bank transactions from the 1st of January 2020 through to about the 2nd week of April of this year. The first column in that spreadsheet is the date of the transaction. The second one is the amount coming in or going out from the bank. And the last one is a description of what the transaction is. So when you go to actually do this for yourself, then you'll be able to see what that data looks like. But I'll just start putting in some of that data into this model so you can see how that actually looks as we move forward. So in our bank transaction data, what we have in there is things like in the first week of the month, we've got $500 going out for insurance. We've got some payments going out to credit cards. We've got some internet payments and things like that. So as we start to populate this data into the model, what we see at the bottom of the page is the information which is relevant to what's actually happening from our bank flows over time. Now, the other thing which is important to include when you're setting up your model is your opening bank balance, obviously. So in this instance, we have a business which has a fairly healthy bank balance at the beginning of our forecasting period, and then over time, then this will sort of change as well as we start to fill in that data. Let me just pull up the second version of this model so we can see what that looks like at the moment. So what you can see here is the data after we've actually populated the Excel spreadsheet with all of the information which is available within the bank statements, and we've filled that out all the way through to the beginning of or up to the date that the bank statements finish, which is the first week of April in our model data. So you can sort of see how that actually looks like as we've finished it. So our bank balances, opening and closing bank balances week on week are going up and down depending on the transactions which are flowing through the business. And what you can sort of see here is that for some of these types of categories of expenditure, that there's some patterns starting to emerge in how that's all working. So ideally what we want to do is to put about 3 months worth of historic data into these models. You can do less, but having a little bit more means that you've got some more a longer period to actually be able to test your trends as they're occurring over. The other thing about adding historic data in is it allows you to do a number of things. So firstly, you can actually make sure that your model's working properly, that your opening and closing balances seem to be matching against your bank statements, so that as you're entering this data, you should be able to test the internal integrity of the logic of the model you've built. You can also start to identify some of the items of recurring expenditure which you might not have remembered to put in there when you were setting up your model to begin with. So for instance, if your utilities, your electricity bill only happens every quarter, you may have forgotten to put that into your initial model when you built it. But this allows you to be able to see that as it's going, so that you don't forget to include those sorts of things. You can also see historic trends which emerge, which we're going to be using later on as we start to build the forecast periods. And lastly, if you've got some variable costs associated with projects, which we do in this case, so as we have our variable costs line in there, it allows us to actually start to make some guesses about what the margins are which are associated with our projects. So so when we're doing our forecasting, it allows us to be a little bit more accurate about what that might look like. There's another Excel document which is in the Dropbox, which is called Other Data, and in there what we have is a list of some drawdown dates for the projects that the company is currently working on. Now they're due to finish in August in our sample data, but they have all of the inflows and outflows of what we're anticipating in terms of income coming in from those projects and going out from those projects, built into a tab in that Excel document called the AR and AP tab, which is our accounts receivables and our accounts payables. So what we'll do is we'll go ahead and we'll load that forecast data beyond where we are now into the model, so we're starting to actually get a sense of what our future income streams are going to look like based on the projects that we actually have that we're working on at the moment. So when you're doing this yourself, what you'll be doing is running your accounts receivables or your accounts payables data out of your account software, and then you will be using that data to figure out the timing on the dates of when you're expecting to actually receive income and have costs going out from associated from the projects that you're currently working on. So that'll be all of the income coming in from invoices that you've generated, which are still outstanding, and the payments which you need to make to suppliers, which are sitting there, which currently aren't there. I'll just bring up for you the next model. Okay, so when we look back at what I find useful is in terms of color coding this model as well, is that once we've actually got data loaded in, is to lock off and color code the data which is for the prior periods compared to data which is in the forecast period. So you'll be able to see in this model that up to the week commencing the 6th of April, this is all historic data, and then beyond that, in the lighter colored cells in this model is the data which we're using as forecast data. So what we've done is we have loaded into the top of this model all of our forecast data all of our known data from projects which we're working on, which are going to take us through to the end of August, and the variable costs associated with those. And again, that data's which we're working off there is in the other data Excel model, which is in the Dropbox there for you, so you can sort of see where this data's come from from our forecast model. The next thing which we need to do after we've done that is we need to then have a look back at our historic data and to start to make some assumptions around what recurring costs are going to be. Now, again, what I've done is I've summarized some of that information in the other data spreadsheet, which is in the Dropbox. There's another tab in that other data which is called recurring costs, and what we have in there is the different categories of expenditure which our historic data shows us typically recurring expenditure which is going out and which we can start to load into the forecast period. So what we have in there were things like, we can see that our insurances are occurring on a fortnightly basis, so we can load that into a fortnightly forecast period. Our internet tends to come out on about the 6th of each month, and it's about the same amount each time. Our mobile expenses come out on about the 22nd of each month, they're about the same each time. Same with our rent, we've got a couple of car leases in there, we have some subscriptions and things like that. So these are all of our fixed costs which we can load into the forecast period to be able to see what we anticipate those recurring expenses are likely to be moving forward. Above and beyond that, what we have is a number of other items which aren't necessarily fixed. So things like our utilities, which are not a weekly expense, but which are a quarterly expense. And we might make some assumptions around just an average of what we think those might work out to. So in this instance, we had a utility bill come out in the week of the 10th of February for about $856. So we may forecast that it's going to be around $900 every quarter moving forward, and we can drop that in to the forecast period as well. Same thing with telephone and these other elements like that. Telephone and general expenses and credit cards, because they are going to be variable, what we often do is we go back and instead of loading in, what we need to do is make an assumption around what the average of those transactions is likely to be over time. And so what we do in that instance is, and you'll find this quite useful in a lot of the spreadsheet programs, is that if you go back, for instance, to our general expenses, and we highlight all of the cells in our general expenses moving back to the beginning of our historic period, it gives us at the bottom of our screen an average amount that we've spent on those things. So the same thing happens in Google Sheets and in some of the other spreadsheet softwares that you might be using. So you can just quickly see what the average expenditure for that particular item is going to be, and we can then use that average to give us a sense of what we think the forecast period should also be. We can do the same thing for things like telephone or other variable expenses where we're not entirely sure what they're going to be exactly. We can use an average model for those sorts of things and then just load them in moving forward. We've done that for both our general expenses and then also for our credit card payments in this instance. So we're taking the average of what we transferred over into our credit card over the historic period, which has worked out to about $2,000 a week, and we've used that as our forecast period as well. Now, one thing just to bear in mind when you're doing this is that because we are using an averaging model in there, we may not have had data loaded into particular weeks moving backwards. So if we have a look at our credit card payments, for instance, in the weeks of the 10th of February and the 17th of February, we didn't have any transfers going out to credit cards. If we were to just take the average of that line without actually putting any data into those weeks, it would give us a bit of a false read. So if you look at the average there, I don't know if you can see at the bottom of the screen, it's showing you that the average for that period is a little bit over $3,000. But what we need to do to make that more accurate is to go back into those weeks where there wasn't expenditure and actually put in zeros into those weeks, so that when the maths, when the logic in the spreadsheet is actually running, it's treating those weeks as a zero. So when it's creating an average, it's not excluding those particular weeks. So when we add those in as a zero, sorry, I'm missing one there, you can see that the average for that period comes down to $2,000 instead of $3,800, which gives us a much more accurate picture of what it is that we're actually anticipating to have occurred. So in doing this, what we've been able to do then is to actually then start to have a look at what our anticipated expenditure moving forward is likely to be. The last thing which we want to add into here then obviously is our wages and salaries as well. Now, for creative industries, wages and salaries is often the largest transaction that we have. So it's probably the most important one. It's important to remember that the amounts that we're loading into our wages and salaries outflows, cash outflows, are just the net amounts that we're paying to staff. So that's excluding our tax and superannuation. When we're making payments to staff, we don't pay them the tax and superannuation every month or every fortnight. In this case, it's a monthly payment to staff. So what we're really loading in here is just the net cash amount that we're paying to them for each of those forecast periods. Now, again, your accounting software package may allow you to be able to see that data, and if it doesn't, then a tool like that Pay Calculator site, paycalculator.com.au, should allow you to be able to calculate what your net payment to each of your staff members is supposed to be. I've also summarised that recurring data in the recurring data tab of the other data Excel model, which is there for you. Okay. The next thing we need to do is we need to actually then start to load in some assumptions around what our future income streams might look like. Now, this is probably the one element which people really do start to scratch their heads and go, well, we have very little sense of what our future income streams may look like. If you have some sort of CRM or pipeline forecasting tool, that data is going to be incredibly valuable at this point. Now, most of our clients, I recognise, probably don't have some sort of pipeline management tool to give them a sense of what their future income streams are likely to be. And that's okay. What we're really looking to do here is to get some sort of sense of what if type of modelling. So it's fine to have multiple versions of these forecast models which you're building, which have got lots of different scenarios that you can test in it. That's the whole point of doing cash flow forecasting. So you can say one baseline model which doesn't have anything to see what that's going to do to your cash flows, and then you can start to build in iterations of that which have different types of income streams coming in into the income lines, which will allow you to test different scenarios. In our example, what we can do, because it's a project type of business, is that we can assume that that the historic type of information, or the historic levels of income which have been coming in, are likely to continue to flow forward into the future. And so we can take an averaged model for our dummy company. That's obviously not necessarily going to work across all businesses, but it's one model that you can use if you want to, if you've got sufficient historic data to be able to get a sense of what that might look like into the future. The other thing which we have in our model is that we can go back and we can test to see what our historic cost of sale was against each of those projects, to see what the sorts of margins were that we had for each of those projects. And we can see that. So what we have done here in our model is that we have taken the average of our receipts over the last, at the end of August, over the last 8 months, so from January to August, and we can see that they average out at about $65,000 a week for this particular dummy company. And we can use that as a forecast for the rest of the forecast period. And the other thing we can see is, if we compare our variable costs to our income for that period, is that our variable costs have generally worked out to somewhere around the 70% mark of our total income. So we can also build in an assumption into our variable costs as to what we think our cost of sales for each of those projects is going to be. So in doing this, what we've been able to do is to build a model which at this point shows us all the way through to the current model, to the current date, how the business has been tracking, and then gives us a sense moving forward of what that future income stream is likely to look like as well. So in this model, the one thing which we are missing at this point is, well, in terms of what we've been talking through, is those last elements of our tax and our GST and things like that. So that's the last element that we really need to start to calculate. And I've skipped forward one step just because it's taking a bit of time to do the screen sharing at the moment. So we've skipped forward one slide, but I'll talk you through the logic of what we've been able to do here. So the first thing which we need to, well, there's a number of common elements which we need to be looking at in terms of liabilities that we need to be paying. The most common ones are our IAS, which is PAYG withholding for staff, which tends to be month to month, and not everybody's registered for monthly withholding. We've also got our BAS, our business activity statements, which include both our PAYG withholding for staff, plus the instalment activity income for the company, plus GST. Then we also have superannuation, which is a commonly recurring expenditure which people can't see from the P&L, and then we've got our payroll tax as well. So they're ones which we often need to calculate. In the other data Excel file, we've put an extra little tab in there which have got some key dates which are specific to our dummy company, so you can sort of see when they're going to be occurring. The transaction dates which are going to be appropriate for you are going to vary by each company, so it's absolutely worth checking with your accountant to find out what the correct dates for lodgement of your particular BASs and IASs and superannuation and things like that are. When we also think about the basis of how you register your company for BAS and IAS is going to vary considerably. Now, we're not going to run through every scenario, so it's worth checking with your accountant or the ATO business portal to see how you've been registered. In our Dunley company, what we've assumed is that we're registered for quarterly BAS, not for IAS, and that we're paying our GST on a cash basis, not on an accruals basis. That's probably the most common setup that we see with most of our clients, so which is why we've used that as the basis of how we've done our dummy data. But we now need to actually move into figuring out how we actually calculate these amounts. So our GST is our first one that we really need to calculate, and in our model we're paying this on a quarterly basis. The calculation that we need to add into this particular cell to allow our cash flow forecast to work is we need to look at the total of all of our income streams which have GST, which when I highlight this you'll be able to see hopefully the blue section at the top of the screen here. There's a little bit of lag there. This is a period of time where all of our income streams which have GST attached to them exist. We need to add all of those together and divide by 11, because in our cash flow models, and I'll reiterate this in a second, our cash flow models, we're always working with GST inclusive amounts. When we're looking at financial statements, they tend to be GST exclusive, but our cash flow models are always GST inclusive. So these are the actual amounts which have come into the business, including all the GST. And then we also need to look at all of the expenditure which have also all expenditure streams that are inclusive of GST, and we need to look at all of those. And in both instances, we divide it by 11. We divide it by 11 because they are grossed up with 10% GST on them. So when we look at the formula there, it's simply adding together all of the income streams for the period that we're talking about. In this instance, it's from the first week of January through to the last week of March. And then we're dividing that by 11, and then we're subtracting all of the eligible expenditure, which has GST attached to it, and we're also dividing that by 11, and that gives us the amount of GST that we are liable to pay for that period of time. Now, you will see that in terms of the expenditure that we are summing together to figure out the outbound components of it, we've excluded all of these bottom sections, so wages and salaries, GST and things like that. They're not included in this calculation. They're not included because those amounts don't have GST on them. So what we're really doing is we're only looking at those outbound cash outflows which have got GST attached to them, and doing the calculation specifically on that. And this is why, going back to when we're setting up the model, we try to cluster our types of expenditure together. This allows us to be able to run this formula on that one section of the Excel spreadsheet without having to add in other rows which might be in non-contiguous blocks of data. So there's our GST calculations. Now, again, that's something which we need to calculate each quarter. We need to make sure that we're capturing the right weeks which that's encapsulating. The second thing that we need to be able to calculate is the amount of PAYG which we've likely to have withheld from our payments for staff over that same period of time. So the way in which we've done that in this instance is that we have, well, two things. Firstly, you should be able to pull this data out of your accounting package. If you don't have access to your accounting package, or it's difficult to be able to easily access that, then we can also just run some formulas to try to figure out what that's likely to be. So what we've worked that back off in this instance is that we've looked at the total amount of wages that we've actually paid over the last 3 months, which is this period here. Now, because we know that on average in Australia, about 30% of all gross salaries are withheld in tax, it allows us to run a rough calculation to give us a sense of what our actual tax liabilities are going to be. So what we do firstly is we divide our total salaries which were paid by 0.7, which grosses it up to 100% of what our potential wages should have been, and then we multiply that by 0.3, so we're taking 30% of our gross. So that's what our little formula in there is doing. And again, what we have in the Dropbox folder is some notes in in a PDF which go through all of the data which we're talking about here, which gives you the logic that sits behind that, and you'll be able to access these Excel models as well, so you can actually go in and see how that works. So you don't need to try to remember all of this. You'll be able to go in and see those formulas for yourself as you move your way through. So in this instance, yeah, we're assuming that of the payroll amounts that we've paid, that they generally, on average, had about 30% tax withheld from them. So we've added that 30% back onto the amount, and then we've calculated it back down to just the tax component of it. So we've grossed up by 0.7, we've multiplied by 0.3 to give us our PAYG tax withholding that we anticipate we're going to be paying for that period. Company PAYG tax, on the other hand, tends to be fairly consistent because it's set by the tax office and generally is applied in your BASs, so that you can see in advance what you're likely to be paying quarter on quarter each year. So it's something which the ATO will nominate which you should be paying based on your prior year's performance. So when you look back at your last BASs, or if you look back at prior periods, you should be able to see roughly what those amounts are. And in this instance, we have just used the same amount for company payroll taxes, what we paid back in February. We've assumed that's going to be the same for the rest of this financial year all the way through, so that it's an amount which was set by the tax office and which is going to be consistent all the way through. Next one, which we're going to talk about, is payroll tax. Now, payroll tax, which in this instance was absolutely applicable for our company, and they were paying it each month. It's applicable to those companies where their payroll exceeds the thresholds nominated by the states in which you're trading. So you'll need to check what the thresholds and rates are that apply to you. And in this instance, what we've assumed is that this company is trading solely in New South Wales. Again, in the materials which are in the bottom of the screen in the Dropbox folder there, we've put some information there around what the thresholds are for New South Wales at the moment. But what we have here in our dummy model is that we have some project salaries which have not continued beyond the forecast of the historic period, and so what that's meant is that in our dummy company, their payroll tax liabilities has dropped away to zero because they're not meeting the thresholds anymore. They're underneath the $900,000 per annum threshold on a month-to-month basis, and so when we're running the calculations for that, they're coming down to zero for our forecast period. Now, again, there's probably going to, in the short term, state by state, each of the state governments have made some provisions to provide some relief around payroll tax moving forward during this period. So you'll need to have a chat to your accountant and see what the implications are for you based around who you pay and where you pay them. But it's absolutely worth having that conversation with your accountant to find out what that's likely to look like for you over the next little while. There's a number of other balance sheet transactions that you also may want to consider when you're doing this part of your modelling. Any assets which you're likely to buy aren't going to show up on your P&L. So if you're buying large items which are of capital in nature, so fairly expensive pieces of equipment or things like that, which would normally go straight onto your balance sheet as assets, you might want to consider putting those in here. Similarly, any loans or repayment plans you may have entered into won't necessarily show up on your P&L. They should show up when you're doing your historic data entry into your model. But loans and things like that, which sit on your balance sheet, may not necessarily show up in your P&L when you're first setting this up. So it's worth just bearing those things in mind as well and making sure that they're taken into consideration when you're looking at the forecast. When we've loaded all this data into our dummy company, what it then gives us is a little bit of a view into the future. Now, what we can see as we move forward, what we're really looking at is the closing cash balance line 61, which is always going to be our ultimate source of truth in terms of how much cash is actually left in the company. Is we can see that at the end of July, when we go to make our BAS payment at the end of July, that this particular dummy company is likely to hit a bit of a cash crunch at that point. We're forecasting a loss or a $20,000 overdraft, or we're going to be going over $20,000 over what our cash reserves are at that point. So we'll need to figure out how we're going to make that work. And then if we move even further forward into the future, then you can see that in this particular instance, our fume date, the date in which the company actually runs out of cash, happens sometime towards the end of October. Now, it's a good thing to know that at the beginning of April, because it means we can start to make some decisions around either reducing overheads, increasing turnover, increasing our margins over the coming months to help solve that problem, or finding other sources of income to help us to get through that. So a few points just to raise when we're building these elements of it. So the number one is point which I just want to raise overall is it's important when we're doing these sorts of cash flow forecasts to be conservative. You're always better to err on the side of slightly overestimating what your expenditure is going to be and what your income is, slightly underestimating what your income is likely to be. So you've got a sense of what the worst case scenario is going to be. There's no point in kidding yourself when you're doing cash flow forecasting. The second thing to bear in mind is that cash flow forecasts do tend to lose cohesion over time. That's to be expected. It doesn't mean that it's not useful to do, but especially in businesses where you don't have certainty of future projects, it's difficult to really have a sense into months and months in advance as to what the likelihood of what your cash flows are likely to look like. Slightly different for screen industry businesses in that when you do have a project, often they are running for multiple months, and so you do at least have a sense of what your drawdown dates and what the income streams for your business is going to be over the duration of those projects. But as we were talking about earlier, it can be tricky to sort of really guess what those future income streams are going to be. So don't be too upset if you sort of get a few months out and then suddenly your model doesn't really make any sense anymore. At least what you've built is a model which gives you a sense for the next few months as to where you're likely to be tracking and how that's going to go, and hopefully is going to give you some indications of activities which you might need to do moving forward to be able to either make allowances for cash crunches which you can see coming up, like our example here where there's a $20,000 cash crunch when a BAS is due, being able to be sensible with payment of creditors around that period of time, or having to go to the bank and get a temporary overdraft and things like that may be options, or putting money back into it from your own savings to cover that period of time may all be options for how your business is going to run. But what we're really trying to do is to get some sort of sense of knowledge around what the future is going to look like. The third thing which is worth pointing out, I did talk about this earlier just in passing, but it's absolutely critical for your cash flow modelling, is that cash flow models always include GST. This is cash we're talking about. We're not talking about the P&L data. This is bank statement data. So all of your transactions which have GST applicable to them need to actually have the GST built into them for our cash flow modelling. And the last thing which I'll just point out is it is important to consider the impact of timing of projects. So if you're not sure about the timing of when a project's going to be occurring, it's better to make a conservative guess, or, as we talked about earlier, run a few different versions of the model to be able to see what that impact might be over time. I'm going to take another little break here before we come back, and we will again see if we can get the PowerPoint up from Sam's machine. We'll see how we go with that. But right now we'll take a short break, and when we come back, we're going to be having a look at what an impact on a downturn in trade might look like, and what the impact of some of the government stimulus options which are available to us moving forward may be as well. So we'll come back in at 11:30 to continue. Can you hear me again? Sounds working again? Okay. So what we're going to be doing now is we're going to be having a look at running various scenarios to see what the impact of changes in market conditions or operating parameters have on our business. Clearly right now, most people are focused on the impact of the coronavirus on our business. So let's start by having a look at what a decline in our business of a quantum sufficient to trigger the government JobKeeper stimulus package might look like. So let's jump in and have a look. What we've done is that we have in our model here, added into row 21 a line which shows a 30% reduction in turnover in our income streams between now and the end of September. Make sure you can see that. So a little bit of a lag on the screen share, sorry. And in row 29, we've also got a commensurate 30% reduction in variable costs for the same period. So this is the two rows here, row 21, our downturn in income, and our reduction in costs is down at row 29. And again, seems to be a bit of a lag there, sorry. But in terms of what that actually does for our forecast period, you can see at the bottom of our screen, once the screen catches up with us, that this actually creates problems for us as early as the end of May. So we're getting into negative cash balances at the end of May based on a 30% reduction in our turnover. And if we looked forward over the forecast period through to the end of the year, that continues to get worse all the way through to the end of the year. In fact, the lowest point that we get to is a negative cash balance of 231,000 before that starts getting better. Obviously, that is not an ideal situation. So what we might do is start having a look then at what government stimulus packages could potentially be doing for us. So let me close that. Wait a moment. Okay, so in our example, we have a number of government stimulus packages that we've started to load in over top of our 30% reduction in turnover. Because our dummy business is eligible to receive the boost in cash flow for employer stimulus, the first thing that it will do is that we can see in the amount that we have to pay for our payroll tax is that we've had a $50,000 reduction in what's actually due to be paid for payroll for that quarter. So even though our formula is exactly the same as it was, we've been able to reduce that amount by $50,000 because the ATO is giving us a credit for $50,000 for that period for the March to June period. That continues into the future. So for the two future periods of PAYG, which we're anticipating we need to pay, they have both also had a $25,000 reduction in what actually needs to be paid out to the ATO because of that cash flow stimulus package which is coming through. In our instance, our business has also applied for and been successful because it's met the criteria for the JobKeeper package to support the 10 full-time staff members, which it has. And that will start being received from the beginning of May in arrears for from the period from the 30th of March onwards. So in our model, we've assumed that these will continue all the way through to the end of September. The figures obviously will vary for each basis for each period on the basis of how many eligible employees are in there and whether or not you've met the assessment criteria. And again, it's probably worth talking to your accountants to get some support to figure out what that means for you. So we can see here that we've got then our 10 employees getting their $3,000 a month of stimulus from JobKeeper coming through for the forecast period. So what we can see just those government stimulus packages doing for this business, which in our last iteration of it, if we go back and have a look at what that looked like without any stimulus, let's make that graph a little bit bigger so you can see what that looks like. When that was happening, then obviously the business was going very, very quickly into decline. But what we can see from adding in just those two stimulus packages is that the cash balances for our forecast period actually are maintainable all the way through until almost the end of the year. We have a very small negative amount that comes through at some point at the end of November, but the business has actually been able to maintain its solvency and trade all the way through just on the basis of the government stimulus packages, which is the whole intention of those packages is to allow those sorts of things to occur. Now, not all businesses will have the same starting cash reserves or the regularity of cash flow as what our sample company has. So in these cases, we really need to consider about how we can reduce costs and how we can increase income. So what we might do is start by thinking about those cost reductions first. Might get you just to move forward one slide if you could, Sam. Okay, so what we can see there is the red line shows what happens. Oh, sorry, go back to our graphs if you would. The red line shows the government stimulus package and what that's actually meant for us, which means that the business has been able to maintain that income stream all the way through. So cost reductions. The first points then you can sort of see there on our PowerPoint that the point of cost reductions really is in this instance is to try to buy time. What we're trying to do is to ensure that we've got the capacity to outlive the downturn in trade which we're experiencing at the moment. We don't know how long the downturn is going to last for, and we don't know how severe it's going to be. So what we're trying to do more than anything is to exercise extreme frugality to ensure that we can maintain cash reserves for as long as possible and to try to maintain those cash flows, not just for ourselves, but also for our staff to ensure that we can continue to give them gainful employment moving forward. In the creative industries, the two highest overheads for almost all of the businesses are firstly going to be their staff costs, and then secondly, their rent. So they tend to be the two big ticket items on everybody's expenditure from across most of our clients. Both the boosting cash flow for employers and the JobKeeper packages they're both designed to help with the first of those, in terms of helping with our staff costs. And there's now a National Cabinet mandatory code of conduct for SME commercial leasing principles, which was released, which provides some guidelines about how we can potentially be negotiating with landlords if we do need to get a reduction in rent. So those links, I think Rich will put up there as well for us to have a look at. But they give us some options in terms of being able to look at how we're going to be able to help reduce some of those costs a little bit. What we're seeing across the whole of the economy, but for creative industries in particular, is that many employees are also asking staff to reduce the number of hours they're working to help buy some more time. So a 20% reduction in staff costs for many creative businesses means that they can actually afford to keep those staff employed for longer without having to stand them down. And similarly, an agreed reduction or abatement in rent helps a tenant trade through a downturn and ensures that tenants and landlords can both return to profit when the business picks up again. So that's really what a lot of the stimulus and commercial negotiations are occurring around at the moment. So while these are the two of the highest, or commonly the two highest areas of overhead for a creative business, it's also worth reviewing all of your expenditure during this time to see where else you can make savings. Now, as you're going through and populating your historic data to fill in your cash flow history, that probably should have thrown out for you some of the areas where you might be able to make some additional savings, things around licensing, or it may be other subscriptions which you're paying for, which you might not need as many licenses for right now. The other thing which to bear in mind is that many banks and finance companies are extending terms to defer repayments on leases or loans right now, so you can apply for those. And there are also some business loans available under the SME guarantee scheme, which the big banks and credit institutions are offering. And you may be able to access these either as a loan or as some sort of line of credit or overdraft facility. So it's absolutely worth talking to your accountant or financial advisor before you apply for those, but they may also help you get through some of these downturn times. Now then, we have also, and I might just need to exit out quickly and come back in again, got a model here for our dummy company, which looks at what would happen in those circumstances where we've actually done a reduction in some of their expenditure as well. So just bear with me for 1 second while I bring that up. So in this instance, what we have is our sample data again, and what we've done is that we've applied a number of different cost reduction techniques for this particular business. The key ones are we've had a 20% reduction in our wages and salaries costs, which is probably the most significant one which we've been able to incorporate. We've also had a 20% reduction in our general expenditures. So general expenses and credit card payments we've decreased by 20%, and we've negotiated with our landlord to also have a 20% reduction in our rent. The last thing we've done is between now and the end of September, we've got a pause on the repayment of car leases for that 6-month period. So those will pick up again after we get through our downturn in trade. So by the time we get to October, we're paying those again, and we have all of our normal expenditure returning back up to the higher levels again by that period. But what this has enabled the business to do is to actually to really maintain strong cash flows throughout this whole period by making some relatively low adjustments to its expenditure. Now, I don't in any way want to suggest that a 20% decline in people's salaries isn't going to be painful for people, but really, as we said earlier, what we're trying to do here is look at scenarios which are going to enable us to allow us to continue to maintain viable businesses over the long term. And when we look then at what that has done, if we compare those 3 scenarios, back over here now, PowerPoint, you can see there that by implementing those cutbacks and savings, additional to the government support, what we've been able to do is to have a business which has really been able to trade through this downturn with relative safety and where it's actually been able to maintain its cash flows all the way through. As I said earlier, it's important to remember that you can't cut your way to success or to profit. Cost reductions will absolutely help you buy time, but longer term, we need to start thinking about some scenarios and strategies to help grow the bottom line as well. So what I'll do here is I'm going to get rid of the screen, and we might bring Richard in to join us for our conversation around bringing in new income streams. Richard's just connecting through. Let's try it again. Sorry. There we go.
Ah. Can you hear me okay?
Yes, you're coming through fine, thank you.
Great. Hello, everyone. Nice to talk to you all actually in person rather than just on the messaging. Yeah, look, I think just quickly, and we'll go through this relatively quickly before we go to questions, because obviously, so Ian, it's currently 10 to 12. We're sort of, I just said to Lisa before, it's probably ending around 12:30, depending on how many people want to ask questions and so on. Does that sort of sound about right?
Yep, sounds right.
Unless people want to hang on for a bit longer. But so anyway, yes. So you've done all your cash flow work, and you've looked at all of the bits and pieces of your business to try and allow yourself to trade through. And I think so. The next question is then, having brought all of that data together and knowing a lot about your business and what you can do to actually allow yourself to survive, how do you rethink about your business in terms of both the short and the longer term, in terms of pivoting or maintaining what your core thing is, or pivoting to do other things? So it really is a time, as I'm sure for most of you are aware, it is a time to really think about, well, you generally think about it, but in a very kind of amped up way, and with not a lot of certainty about how you pivot your organization a bit to take advantage of some new thinking about what you might be able to do and how you may be able to get some revenue into your business. There are some, obviously there's a few on a sort of government level, there's all of the, other than the support that's there through JobKeeper and JobSeeker and so on, but all of the state governments and Create New South Wales and others are all putting online measures that are there to try and assist companies to think through their business or do new things and focus on development or whatever it might be. So obviously spend time working out which ones of those can work for you. And there's obviously ones that that are very small government, whether it's in New South Wales, a service, newsouthwales.gov, about small business. And then there's also the City of Sydney, for example. So we can put up those, I'll put up those links in a minute. But it's those sorts of grants for small businesses that you may be eligible for that can really help you with just to kind of both stand still but also move forward. And it's also looking to what you may do for the, for your business in the future and determine how you're going to get there. And, this is a good time to revisit. I'm assuming everyone does business planning, but if you haven't, do it. But if you have done business planning before, you should be starting to think about, what are the strengths and the weaknesses, all the opportunities and threats that are there before. What can you do now? How would you look at your business today in the light of current circumstances, and then thinking about what that business might look like in the future, and then also look at things like, the landscape, how is the world changing? I mean, who's going to be looking for content, how that's all going to work. So all of those sorts of general things you would do in your business planning. So there, the other thing that we always think about is, as business consultants in terms of income streams, is looking at, there's probably 4 kind of key ways that you can think about how you get income into your business, and it's summed up in something called the NSW matrix, which we often use to help people consider what their options are for growth. The NSW matrix we'll put that up, but it can be pretty easily, oh, there you go, pretty easily found online within a quick click. The first one is the market development or market penetration, and that's really just about trying to find selling more of your existing projects or products to your existing markets. And we sort of think about in terms of selling more of your existing shows to the ABC or things that are sort of sitting on the shelf, or but that's kind of staying, you're just essentially trying to get to the market that you already know and give them more. Second is selling more of your existing products and services to new markets. So this is looking at, you know, who are the other buyers that might be out with that you haven't actually sold your shows to. So someone who's not the ABC, if they're your main client, you know, HBO Max, or it could be Apple, or it could be whoever it might be. And then the third one is selling new products or services to existing markets. So this is product development. So this is really looking at what sort of product can I sell to the ABC if they're my main client base at the moment, or whoever my main client base, what can I think of that's a new shorter form? Can I do them interstitials? Where are they finding at the moment the audiences that they're wanting to get to, and how do they actually get how do I get new products to them that they may be demanding or have a shortage of? And then the final one is selling new products or services to new markets, and that's diversification. So that's could be selling all sorts of different things. I mean, on one hand, I keep thinking of someone like the gin with alcohol in my mind. I think of people like in the gin business who, you know, if you were making gin, you know, how are you going to get that? You could get it to your existing clients. You could get it to new clients. You could sell new versions of that gin with tonic in it that goes directly and delivered directly to houses. Or the fourth one is you can actually start distilling hand sanitizer. So it's actually looking at ways that you may be able to innovate with the content that you have. And a really interesting example that I had was I bumped into from a distance when I walked to the beach not long ago to a guy who's a principal in one of the big commercial television commercial producers. And they were saying, look, you know, they've done everything that Ian's talking about. They looked at JobKeeper, all of their staff and their principals have taken a 20% pay cut. You know, they've done all the things in terms of the way their business works. But what they've worked out is also, what they're finding is that there's a massive demand for new sorts of advertising content, particularly branded content, and there's no one supplying it because no one can get out and make it. And they're having to think about how they can make that content with, you know, smaller numbers, you know, hit a branded thing. So they're just trying to rethink all of that, where the demand's sitting at the moment and how they can actually service that demand in a way that they previously wouldn't have thought about. So in any production company, you have to start thinking about what is the interesting thing at the moment is that there's a massive demand. There's an audience demand for content. There's actually a demand among the advertisers, even though we're in a time of contraction or a time of pause. The advertiser have got these amazingly captive markets. So how you can actually create content that actually hits those is one of the things a lot of those companies are thinking about. So it is a time for companies that maybe have been conventionally thinking about how they run their business and they get their income in and they get commissions or they get this or that and the other, to really start thinking about what are the things that they can do in the short to medium term to just keep the cash flowing enough for them to come back and keep back into doing their kind of conventional business. So that's about it from me and Ian, other than questions, unless there's anything you want to add on that.
Yeah, look, I think just outside of just income stream and increasing those as well, I think there's just a few other things just to emphasize around communication and actions right now. So, you know, one of the important things, which probably the most important thing I hope anybody takes away from this, is how important it is just to increase your communication and your propensity to actually act on the information that you've got. So when I say increase your communication, I mean talk to your accountant and your financial advisors, get their support and their advice. This isn't business as usual, so nobody's expecting you to be able to navigate this in your way in which you would with a normal downturn in business. They're there to help you and they're there to support you. So, I understand they're probably incredibly busy as well, but, have those conversations and get their advice. Talk to your banks and your finance suppliers. They're also incredibly busy. It's taking a long time to get through to people. So don't wait to ask to put loans on hold or to get loan repayments. Get in the systems now and start getting those